Mr. Singh, morning. This is Reema here. Let me get to your margin guidance. You are guiding for margins of 20.5 to 21% next year, which is basically about a 200 basis points margin expansion. Now, you've outlined a couple of factors driving this. The Encora synergies, you will cut down on cost. But how much of that 200 basis point margin expansion upgrade is on account of AI, internal AI usage, and better pricing because of AI?
Most of it is on account of the AI interventions, the automation that we're driving through the entire function space that we have. One of the biggest things that we've done outside the results for the year that we've announced over the last 12 months has been the fact that we have made ourselves in many ways client zero when it comes to driving automation and AI-based interjections across the organization. So when we gave a guidance day before on the investor call of jumping by more than 200 bips, that's guidance where, given everything that's been done, we feel that that's a number that we believe we will hit very solidly, and we will hit for sure.
So you're saying most of the margin upgrade is on account of AI-related factors, right, of this 200 basis points?
And let me just be very clear about that. AI-based interventions across our own internal operations. What we've decided to do is to make sure that the absolute G&A cost stays exactly where it is. We don't allow the absolute cost to go up despite the considerable scaling that we expect to see on the revenue front ahead of us.
Congratulations, good set. It's rare to see an IT services company raising guidance and sounding as optimistic as you are in the overall IT services set. Now, having said that, so just a basic question, because I mean the numbers are well known, and we'll talk about some of the numbers in greater detail. But is the way forward set in that way? This is what these AI foundational models can do. This is where IT services companies can come in. I mean, is the playbook, the framework, so to speak, do we have that playbook now from your perspective? Or you think that itself is still evolving? Anthropic, for example, just, I think, over the last 24 hours introduced a suite of products for financial services, banking. I mean, you must be well aware. So I'm just trying to understand, is that relationship set in terms of how this will work?
The frame, Nigel, is set. And there are obviously going to be advancements that happen on the LLM front. Prashant, hi. My apologies. There are going to be changes, Prashant, when it comes to the LLM set. There are going to be changes and developments, as is natural, when it comes to the tool sets. But as far as the services layer, the integration layer is concerned, to your immediate question, the frame is absolutely set. For firms and teams that focus on labor as a default, growth is going to be increasingly hard to come by, because that's not the value pool that is going to expand. The value pool that is going to expand and is already expanding is for firms and teams that can focus on AI native process redesign, that can focus on creating delivery models that also have domain enabled agents imbued in them. For firms and for teams, again, that can actually help enterprises with what they need, which is creating AI-ready data pipelines. So the frame, again, to your immediate question, for services firms in the integration layer, in the solution construction layer where we are, is set. While there will be changes, there will be continued advancements when it comes to foundational models or when it comes to the tools that surround the broader AI space.
Sudhir, you said you're planning to keep your G&A cost unchanged, even as the company continues to grow very fast. What does that mean in terms of your headcount addition plans? And if AI is going to continuously drive this kind of productivity and interventions at the cost level and at the revenue level, do you think your margins can be on a structural uptrend? I'm not asking for an FY28 guidance on margins, but just asking the direction. FY27 you've outlined, it goes up, minimum 200 basis points. But do you think there is a structural uptrend to margins given the AI-related factors?
And the short answer is yes. If we can drink our own Kool-Aid, which we should, if we're going out there in the market as a tech services firm talking about AI enabling enterprises, we have to be client zero ourselves, for ourselves. So the guidance that we've given for 20.5 to 21% EBITDA for FY27 is a guidance that will be beat for sure and has to be beat in FY28.
So 27 expansion, 28 expansion as well, right? Margins continue to expand into 28.
They will. They absolutely will. I'm not sure if it's Prashant or Nigel on the other side, but yes, they will.
Prashant here so far, but Nigel will come in as well.
Right.
Yeah.
Uh-huh.
All right. Okay, so that's about margins, Sudhir. What about on the free cash flow side? Now, you have upped your guidance. Earlier, it was 70 to 80%, free cash flow as a percentage of PAT. Now, you've upped it to 100. What's gone behind this upgrade?
I think we're looking at what we've already achieved in Q4. Our normalized free cash flow to PAT has come in at 150%. The guidance going forward for next year that we've offered is only 100%. What we've done over the last 12 months in particular, one is what I talked about, AI interjections at scale within our operations. The second thing that we've done is we've approached the entire cost structure very closely to make sure that the FCF to PAT ratio goes up. We hit 150% in Q4. We think 100% is the least that we should aim for and the minimum that we will deliver going forward.
Okay. And on travel and BFS, on travel, because it's one of your large verticals, it was a significant contributor to your growth last year. There is concern on account of the Middle East crisis. Have any of your customers, clients paused projects or they're rethinking the planned ramp up? And even on BFS, that was the only major vertical which actually declined in the quarter gone by. If you could tell us the reason and the growth outlook.
Sure. I mean, if you look at travel in FY26, the year that's closed, we grew more than 70%. Banking, we grew more than 12%. I suspect, given the long-term, the secular tailwinds that travel has because of the one order, one offer-led transformation that's happening, and because of the airport redesign as retail malls on an ongoing basis, travel is likely to be one of the fastest growing verticals for Coforge in FY27 as well. Banking again should do better than the 12% growth that we delivered in FY26.
Hi Sudhir, this is Nigel on this side. Need to ask you one question before we let you go. Over the last many quarters, we have been pushing you. When will you go to that annualized run rate of $1.5 billion, $2 billion? Now you're already doing a pro forma revenue of close to $2.5 billion if I include Encora. So, lekin ye dil mange more, right? When do you get to around $3 billion? Nomura, in their note this morning, they are talking about $3 billion in FY28. That should be the target, $3 billion by March 2028?
We'll get there very soon, Nigel. Last 9 years, we've grown at a CAGR of more than 21%, and for the last 9 years, our PAT has grown at a CAGR of more than 24%. That's not a track record that any IT services firm over the last decade can come even close to. I totally agree with you. Ye dil mange more, and ye dil mange more bahut jaldi more. We should be hitting, hopefully by the time we have this conversation, same time next year.
Okay.
So we should be having a conversation that's very real around when we cross the $3 billion mark.
Okay, all right.
And,
so that'll be sooner than expected.
Okay.
And just one thing, just a basic fundamental point, Sudhir, how much of the revenues, and this is, we did an IT town hall recently, and we had Frank D'Souza, ex-Cognizant, and somebody from Fractal, and we had a whole bunch of people from the sector, and it would have been great to have you as well. But one thing which came out is that pricing will increasingly shift towards effort and outcome based. At Coforge, is that already happening? All the outstanding business that you have to execute, could you give us a sense of how much of it is outcome based?
It's increasingly and very quickly moving to outcome-based, Prashant, on an ongoing basis. As I've said always, for firms that are able to drive outcomes and orchestrate those outcomes for businesses, growth will continue to compound. It is compounding in our case. One of the largest, I suspect the largest program that we have running across the firm today, and I can say that with absolute conviction, is a 100% outcome-based program that we're running right now. So we've already made that switch, and more importantly than just making the switch, we made it successfully. So it is outcome-based, and those are the firms, as you rightly noted, which are going to compound in the future. Firms that keep talking about labor as a default and not outcomes, are the ones that are likely to get left behind.
Sudhir, what percentage of your book today or revenue or order book would be outcome-based, outcome-led?
We don't call out that number in our results at the current point in time, Rima. Maybe going down the line, maybe a few quarters down, we'll start talking about it.
But you're saying this program to move everything to outcome basis is on. I mean, it's what you're actively. I mean, clients are of course asking for it, I'm assuming, but you're also sort of proactively moving towards it.
We prefer that. We prefer that largely because of the integrity of our delivery model. The best example of which is 95% of our business is repeat. We believe that we will deliver against the commitments we make, and we're looking at a past record, not future projections. So whenever the option arises to even propose, forget respond, we do lead in, not necessarily always with 100% outcome-based, but with an increasing portion that is outcome-based.
Sudhir, always a pleasure talking to you. Thanks a lot for joining in. Congratulations on the past quarter. And you look like you're going from strength to strength. So we wish you well, and we look forward to have a conversation at the end of the first quarter.